This is the $1 million portfolio margin. Taking a look at all the strategies in this portfolio, there are 55 different algorithms, and so we go over the margin for each one of those. This is an NQ day trade, E-mini S&P day trade, A-mini S&P day trade, and so on and so forth, gold day trade, silver day trade. And so we've categorized this. How many NQ day trade strategies are there? How many E-mini S&P day trade strategies are there? And so you see the list. There's 10 NQ strategies, 12 ES day trade strategies, 5 gold day trade strategies, all the way down: silver, crude oil, soybeans, platinum, natural gas, RBOB, euro currency, and then these are the day trade strategies, and then the associated current trade station margin. Different brokers have different margins, 25 to 50% of the full margin, sometimes for day trade margins. And then you have the overnight strategy. So you have 3, 4, 5, 6, 7 overnight strategies, and those are full margin. So you see the full margin for those. And what is the total margin if you take the number of contracts, the number of strategies, the margin per contract, and then the total. So if you had a net position in every strategy at the same time, how much capital, how much margin capital would it require? So the total margin capital that it would require at TradeStation currently is $128,000 to trade the $1 million portfolio. The max historical drawdown is $40,000. The max recent drawdown is $36,000, and the current drawdown is $11,439.80. And so you see the $1 million portfolio. Let's look at the performance summary first. But if you actually want to look at the drawdown spikes, and you take a look here, it's kind of at a sweet spot. It spiked down. And so what this drawdown does is every time there's an equity peak that's at 0, it's hard to see the zeros, and then every time there's a drawdown, see, this drawdown is associated with this drawdown. And then, say for example, that drawdown is associated with that drawdown. And that drawdown is associated with this drawdown. And so you see these drawdowns right here. This drawdown is associated with this drawdown right here. And then you see this one and this one are this drawdown and this drawdown. And so then you have a quick spike down right here based on those drawdowns. So that's how the drawdown curve works against the equity curve. It goes the opposite direction. If the equity curve makes an equity peak, the drawdown curve is at 0. If the equity curve is off its equity peak, then the drawdown curve decreases. Here's another example right here associated with this one. And so you see all these associations of drawdowns, and the drawdown curve related to the equity curve right here. And so that's how this setup works. The drawdown percentage, it's just what this platform is assuming is that as your equity goes up, the percentage of the drawdown is smaller. So the dollar drawdown is really more accurate. The drawdown is not less on a dollar basis. It is less on a percentage of how much capital you started with basis, assuming you don't take any out. Trading one contract per strategy without any sort of compounding. This is how the margins are calculated and how the setup works. And if you look at the performance summary, you can see the worst case drawdown right here, 42.35, and you can see that the current drawdown is right at the $11,000 mark. I calculated that out so it's accurate, and you can do that from the total the list of trades. Here's the total trade analysis: $48 average trade profit after $25 round turn slippage and commission. So if you look at the list of trades, you can see the current equity is at 1,312. The total profit, assuming that the starting capital was $100,000, that's just a setting in the platform. That's not necessarily what we recommend for this portfolio. But if you start with $100,000, your cumulative profit is 131,129.20. Then your current equity is around 1. It's hard to click on the very last bar, but you see that the last one should be 13112, and the equity peak is around 123,568. You see that most recent equity peak there, and so it's about, the current drawdown is almost $12,000, between $11,000 and $12,000. And so the amount of capital you need to trade this, $1 million portfolio, the absolute minimum value that you'd probably want to trade this with is the margin, the total margin of 128,474 plus the max drawdown minus the current drawdown. And that's pretty aggressive on one hand. You want to allow for worst case drawdowns. You don't want to just stop if it hits a worst case drawdown. So what you could do is you could say, okay, I have $11,000 cushion to a worst case drawdown, and I could trade this with 170. I could trade the $1 million portfolio with 170K. I could trade it with, less than that, with 150K. Extremely aggressive would be to say, you know what, only none of these strategies, you're not going to see a net position in all 55 of these strategies. You're not going to see 10 NQs, 12 ESs, all net in one direction, all at the same time. And you probably wouldn't. The most you'd probably ever see is about 50%. So you could take 50% and say 65K would be your margin requirement, and your worst case drawdown would be another 30K, so you're talking 100K. So you could absolutely extremely aggressively trade the $1 million portfolio with 100K. And so you're in a little bit of a drawdown here. So looking for a pop next week. I like to start a month after there's been a drawdown like this going into the end of the month. Let's look at the daily period analysis. So we ended on a down note. It was up for the month. The monthly period analysis shows us plus 17,911, recovering from July. So about break even on July and August. Big June and down May. But we had this nice streak here from last October. Actually, September wasn't bad, but if you look at September through April, those are that's a sweet spot from last year. So we're looking maybe to capture another sweet spot. A lot of the portfolios show the same sweet spot in the fall and in the spring. So September, October through April is a nice time to trade. We've just went through the summer and up, but not a lot, not as good as this time period right here. So looking for a time period like that going forward, trying to capture that, when you trade, you want to assess your risk and you say, okay, here's my risk and here's my potential reward, and you want to try to jump on these winning streaks. And so it's up for the month, but it's break even for the last two, and we ended down for the on the week. It was down. If you look at this, it was a pretty sour week. Take a look. 25th was Sunday night, and so you're up 1,900, and then pretty much losses the rest of the week. So down a good 10K plus on the week, and so that's where the drawdown came from. Had an equity peak back here, I believe, on 8/23, and then just a drawdown of another 10K from that equity peak. And so looking to catch the cycle of drawdown, and you can do the $1 million portfolio. It's a $1 million portfolio because of the mindset and the ability to trade multiple contracts. You can add up to 4 contracts on this if you want, and if you want to deleverage a little bit, the mindset is $1 million. But I mean, if you're just absolutely go for broke type of, I'm going to risk 100K and just run with it, you could still manage your risk on a worst case drawdown basis. But the more capital you have for this, the better your opportunity is to withstand any worst case drawdowns or additional volatility or increases in margins. You have to consider the fact if volatility increases, the exchange can increase margin, and so you have the opportunity to trade multiple contracts as well. So that is the update for the $1 million portfolio as of the end of August and what we're looking forward to going into September and the rest of the year.